Did you know that the average UK household is expected to spend around 40k on taxes in the tax year ending 5th of April 2025? Any changes the government makes to the tax system can have a significant impact on your take-home pay and your overall financial situation.
This budget raises taxes by £40 billion.
In this video, I'll walk you through the 7 major tax changes coming into effect this year, explaining what they mean and how they might affect you.
We committed to reforming stamp duty land tax to raise revenues while supporting those buying their first home.
So first, let's start with stamp duty land tax, which is set to undergo some important changes. Stamp duty is a tax that's paid when purchasing property. Starting this April, the thresholds for when you begin paying it are being lowered. Currently, first-time buyers don't pay any stamp duty on properties up to 425k, as long as the total value of that property doesn't exceed 625k. For everyone else moving home, the nil rate band is 250k. However, these thresholds are being reduced. For first-time buyers, the new threshold will drop to 300k, whilst for others it will fall to 125k. This means that more of your property's purchase price will be subject to stamp duty tax.
And increase the differential between fully electric and other vehicles in the first year rates of Vehicle Excise Duty from April 2025.
The second major change is to Vehicle Excise Duty, also known as VED, and this will likely impact a lot of people. At present, electric vehicles are exempt from this road tax, but starting April 2025, they will no longer enjoy this exemption. For electric cars registered after the April 1st, 2017, owners will need to pay a standard annual rate of £190. And whilst petrol and diesel vehicles are also affected by VED adjustments, the most significant impact will be on high emission vehicles. For instance, if you're considering buying a Range Rover 5 litre V8, next year your first year VED charge will double from £2,745 to a whopping £5,490. That is a substantial 100% increase. These changes alone are expected to generate an additional £2 billion in revenue for the government by the 2027-2028 tax year.
Today, we will increase the lower rate of capital gains tax from 10 to 18% and the higher rate from 20 to 24%.
Next up, we have capital gains tax, also known as CGT. This tax applies when you sell chargeable assets worth more than £6,000. And this could include anything from cryptocurrency through to second properties or other valuable personal possessions that you own. You do get an annual exemption of £3,000 each year before CGT kicks in. However, at the end of 2024, CGT rates were increased significantly. For basic rate taxpayers, the rate rose from 10% to 18%, and whilst for higher and additional rate taxpayers, they saw their rate increase from 20% to 24%. This means that if you sell an asset in 2025 that's subject to CGT, such as cryptocurrency, you'll face a much higher tax bill than if you had sold it in 2024. A related change to this involves business asset disposal relief, which previously allowed qualifying business disposals to be taxed at a reduced CGT rate of just 10%. However, this relief is also becoming more expensive for business owners, and this is due to the high cost of the government for it. It's costing them approximately £1.5 billion annually. Starting April 2025, the reduced rate will increase to 14%, and in April 2026, this will rise to 18%. For example, if you sell your business in April 2026 with a profit of 100k, you'll now need to pay 18k in stamp duty versus a 10% currently. That is a significant difference. The fifth change affects furnished holiday lettings, such as Airbnbs. From April this year, many of the current tax benefits for short-term rental properties are being removed. Higher and additional rate taxpayers will no longer be able to fully deduct mortgage interest from rental income. Instead, they'll receive a restricted 20% tax credit on their mortgage interest payments. For instance, let's say you're a higher rate taxpayer earning 24k annually from an Airbnb property, with mortgage rate interest costs of around £5,000 per year. Under the current rules, your taxable income would be reduced by the mortgage interest amount, £19,000, resulting in a tax bill of £7,600 at 40%. After these changes take effect in April, you'll no longer be able to deduct the full mortgage interest amount and will instead pay tax on the full rental income of £24,000. Whilst you will receive a 20% tax credit on your mortgage interest of £1,000, your effective tax liability will rise by £1,000, from $7,600 to $8,600 annually. Additionally, capital gains tax rates for furnished holiday lettings businesses are changing too. If you sell such a business now, for example an Airbnb, you may currently qualify for business asset disposal relief and pay just 10% in CGT on profits from the sale of your business. Unfortunately, from April onwards, this tax relief will no longer apply. Instead, residential CGT rates of up to 24% will be chargeable for higher and additional rate taxpayers.
We will introduce VAT on private school fees from January 2025.
The next major change is the VAT on private school fees. The government are amending the VAT Act to remove the current VAT exemption for private schools. This means that from the 1st of January 2025, primary schools will start charging VAT on their fees. And it's not a blanket 20% change on absolutely everything that a private school charge for, but it will apply to the cost of education and the cost of boarding. The draft legislation does say that other things closely associated with education are exempt, which could include costs of school meals and any exam fees. However, it means that the bulk of these fees, education and boarding costs, which are the most expensive, will have VAT applied to them going forward. However, it is currently expected that nursery classes will be exempt from VAT.
We will abolish the non-dom tax regime.
The final change we're going to experience is to non-dom status. Starting in April, domicile will no longer determine your UK tax obligations. Previously, individuals claiming non-domicile status, such as declaring Dubai as a permanent home, could avoid paying UK taxes on worldwide income and gains. However, under the new rules, all UK residents will be required to pay UK tax on their global income and gains, regardless of where they consider their permanent home to be. There is, however, a temporary relief in place for those who have lived outside the UK for at least 10 years before returning. This 4-year foreign income and gains regime allows such individuals to avoid paying UK taxes on foreign income and gains brought into the UK during their first 4 years of residency. After this period, though, they will be fully subject to UK taxes on worldwide income and gains. These changes represent some of the most significant tax reforms in recent years and could have a major impact on your finances, depending on your circumstances. Hopefully you now have a clearer understanding of these upcoming changes and how they could affect you. In addition to understand how these upcoming tax changes might impact you, it's worthwhile understanding how you can manage your money like the elite. If you want to build a substantial wealth pot while still having fun and enjoying life, watch this video here. Equally, if you want to find out about similar topics such as this, please don't forget to like and subscribe to the channel. It really helps support us and allows us to bring more updates like this to you. Thanks for watching, and I hope to see you next time. Ta-ra.